Do you want to invest in the stock market, but you don't want to buy stock and wait a year or maybe even longer just to make any money? Well, what if I told you that you can invest in the stock market, but instead of having to wait a year, you can make money every single week like clockwork? Like you can literally just get a check in the mailbox. It's so amazing. I'm talking about trading options. And if you think that sounds confusing or risky, you are totally wrong. Check out this video. Be sure to stay till the end. I just wrapped up a live event and I walk through exactly how easy these two strategies can be: selling a put, selling a covered call, and you literally create cash flow every single week for yourself. Like I said, make sure you stay to the end. I do screen sharing and I show you exactly how to put the orders in, how to calculate your rate of return, and check out the links below as well. Be sure to subscribe to this station because I'm putting up a video every single day with great tips and tricks for you to help in your trading journey. Cheers for now. Most all this content, really, we're going to have two things that we're going to talk about: selling a put and making money, and selling a covered call and making money. That's it. We're going to go over all those details all throughout the week. And cool. So we're going to get started. I like to be prompt. Welcome to day 2 of our lunch and learn. So yesterday we had our rock star day to start off. We kind of went through some information, some basics, kind of how stocks work, how options work, that sort of thing. Today, we're going to really dive deep into option trading. Don't worry if you don't have any experience. And I'm going to break it down very, very easy for you guys in a lot of different examples. So just like we had yesterday, keep it very interactive. My goal, like I mentioned yesterday, is I really want you guys to learn the content that you're here to learn. I want you to understand and to be able to see yourself doing exactly what I'm doing: selling a put, selling a call, collecting income from week to week, and living an amazing lifestyle in the process. So that is really my intention. So let's start with day 2. So today we're going to really dive deep into selling a put. But remember what we talked about yesterday: there are only 2 strategies that you need to know. Now, listen, guys, trading and selling options, it can be as hard as you make it or as easy as you make it. Oftentimes I hear stories about people, they look at charts, they do this all day, they do that, they subscribe to all these different expensive things, and you really don't need to do that, especially at the beginning. You can have a small account, not have any experience, and just start off with like baby steps. So really, those are the things that I'm going to focus on this week, right? So 2 strategies that you need to know. Number 1 is selling a put. Number 2 is selling a covered call. So today we're really going to dive in on selling a put. Let's get started. What is selling a put? We kind of touched on this a bit yesterday, but today we're going to go in a lot more detail. Basically, selling a put is this: you are agreeing to buy 100 shares of a certain stock. That's called the underlying. Remember, we talked about that yesterday. And you're agreeing to buy those shares at a specific price. That's called the strike price. We touched on that yesterday. And then the third part of that is that you're agreeing to buy those shares at that specific price before a specific date. So that's going to be the expiration date. So really those are the 3 main pieces of selling an option in general: the underlying, what stock you're trading; the price, the strike price, how much you're going to buy those shares for if you get assigned, if the price drops down, right? And then there's a time frame. It's not some unlimited time frame. The stock has to go down to your strike price before the expiration date for you to have to buy those shares. So those are the 3 pieces that we're going to talk about starting off: the underlying, the strike price, the expiration date, right? So for that commitment, you are paid money, right? You're paid what's called a premium. Very similar. We talked yesterday about car insurance. I have a car. I pay the car insurance company a premium, right? They are committing to fix my car if I smash it. It's that simple. And the contract lasts for a certain date. Now, what happens when I have car insurance for 6 months, and let's say my car insurance expired yesterday, but I didn't renew it? I didn't pay the premium again, so I didn't renew the policy. It expired yesterday. Today I'm driving and I have an accident. Do they pay? No, because the term is over. This is the same thing, right? You're agreeing to buy a certain stock at a certain price before a certain date. You're paid a premium. Now, keep in mind, you keep that premium no matter what happens. That's one of the things that oftentimes, especially new traders, they get a little bit confused about. It doesn't matter what happens to the stock. The stock can go up, the stock can go down, the stock can stay right where it is. The stock can even go bankrupt. It doesn't matter. You keep the premium no matter what happens. When do you get paid the premium? You get paid the premium when you make the trade. So when you commit, right then when you input the trade to buy those shares at that price before a certain date, if it reaches that price, you're paid money. It goes in your account. You keep that no matter what. So that's something that you want to keep in mind. Now, I think we touched on this yesterday, but we're going to talk a little bit about it today, especially for all the new people out there. You can be a buyer or you can be a seller, right? So there's always going to be two people, two different people on each side of this particular transaction. The person that's buying the put, the person that's selling the put. We, as a reminder, are always going to be the people that are selling the put. The buyer, they pay the premium, right? And the reason why they're doing that is they want to make money if the price goes down. Now, I said they can make money if the price goes down on this slide because it's not like a static equation. So, and I don't want to get too much in the weeds here, but I do want to impress upon you this. If somebody buys a put and they want the price to go down because that's what a put buyer does, right? They want the stock price to go down. Even if the price goes down, that doesn't necessarily mean that they make money because time is the other part. As time goes on, time is like eroding the price of that premium. So that's to our advantage. Now, I don't want to confuse you guys. I just wanted to kind of throw that in there. We're going to talk more about that as we go this week. But basically, they're paying the premium and they want to make money if the price goes down. The most that they can lose when you're an option buyer is the price that they paid for the premium. So that one of the advantages of somebody buying an option is they don't have unlimited risk. So that is one of the advantages. However, it's still not a good not a good strategy. So like I said, we're always going to be option sellers. Most options, like I mentioned yesterday, expire worthless. That's good for us because that means that we got paid the premium, the option expires worthless. There's no more risk after the expiration date. We're going to talk more about that as we go on today. The option seller, that's going to be us, right? We keep the premium. We keep it no matter what happens. For that premium, we are making a commitment to buy a stock at a certain price before a certain date. Now, you also can get out of a trade at any time. And I put this on the slide early, and we're going to talk about this throughout the day, probably later in today's session. But I want you guys to understand that when you make a trade, you're not stuck in that trade. Here's the thing, everything is super flexible. You can make a trade now, you can get out in a minute, you can get out in an hour, you can get out tomorrow, the next day, anytime before the expiration date. I'm going to talk more about how that works, but I wanted to make sure that you guys knew that you have some flexibility to do that. It's not, you're not stuck in stone to be able to keep that trade open until that expires, right? Let's see. Option sellers. So again, you choose three things. You're choosing the stock price, the price you want to pay for it, and the time frame. It is very, very easy. I think as we move on, it's going to start clicking. There's not a lot of like pieces to what we're doing. It's just like a handful of things here and there. And as you practice, it will start to click and make more sense and become automatic for you. Let's see. When you choose this strategy, when you use this strategy, rather, when do we want to sell a put? That's a great question, right? Really, there's two times when we want to sell a put. If you want to buy a stock anyway, so most people are on this session. Typically, they're on, my trainings that I do because they want to trade options. But sometimes people just want to straight up buy stock. Like, hey, I really like Apple, and I don't have any Apple stock, and I don't have any stock in general, and I want to buy some stock. So you can use this strategy to be able to buy stock. Like, here's the thing, guys. Like, why would anybody want to pay sticker price for anything ever if you have the ability to pay at a discount, if it's the same thing, right? So, like, I think I mentioned this yesterday. I go to buy a car and I see the MSRP sticker on the window. I don't want to pay MSRP. I want to talk to the sales guy and I want to get a better deal. If I go to the mall and shopping, I mean, retail stores don't typically, bargain with you. But let's say I go to some, flea market kind of place and I see some things that I like. I want to bargain with them and I want to pay a lower price because why would anybody want to pay a higher price? It's just not logical. So if you're in a position where you kind of want to buy some stock anyway, you can use this strategy. The second thing that's probably more applicable to us is when we want to create weekly income. So here's the thing. You can do this on a small scale, mid scale, big scale. It's whatever you make it be. Part of that has to do with, how big your account is when you start and how much, confidence that you have and that sort of thing. I encourage you when you're new to get your feet wet, learn how to, walk before you run rather. But the strategy that we're using selling puts is to create weekly income. You can also create income in a different way because the expiration date, and we're going to talk more about that today. But you don't have to. I say weekly income a lot because that's really what my focus is. But you don't have to sell a contract that expires this Friday or next Friday. You can choose a contract that expires like a month from now. Now, when might somebody want to do that? Here's a great example. Let's say somebody has, a bunch of money in a savings account, right? And they're getting, I don't know, a few pennies of interest, whatever. And let's say it's a significant amount. Now, I'm a big believer that everybody should have savings. That's important, like a rainy day kind of fund. However, sometimes people, keep too much money in there and you're losing income that you could be making somewhere else. And this is kind of what I'm talking about. Let's say if you have a savings account somewhere else, you can shift part of that into a brokerage account, use the strategies that we're talking about here, and create income for yourself on an ongoing basis. That can be significantly higher than, some saving. I don't know what savings rates are. I think they're, I don't really pay attention to that because that's such a small, percentage. But that's another way that you can use this strategy. So selling a put, really it comes down to this. All this stuff, honestly, I think by Friday, many of you might be like, man, this is a lot easier than I thought it was going to be. Because really, it's not that hard. Selling a put is what? You're buying a stock that you like anyway, and you're buying it on sale. So that's the worst thing that can happen. That's your commitment, right? You're buying something that you want, that you like anyway. You're buying at a cheaper price than what it's selling for today. And yeah, that's like worst case scenario, right? So let's go through the three things that we always want to look at and decide as we're selling a put. One is the stock price. What stock are we going to trade, right? Is it going to be, ABC, XYZ, Disney, Tesla, General Electric, whatever? The strike price. How much are we going to commit to pay for those shares, right? That's important. And then the third thing is the expiration date. How long are we comfortable for maintaining this contract? Again, I talk a lot in my trainings and my videos that I do online on YouTube and such. I talk mostly about short term. I'm a big believer on short term for a couple reasons. Number one, I don't know what the market's going to do tomorrow. And oftentimes there's a lot of volatility. Something big can happen. Trump can say something big on the news. Elon Musk can say something big on the news. There could be some crisis in another country, and that could significantly, affect the market in a very quick fashion, right? So I want to kind of like be in fast, get paid, and then exit. Be in fast, get paid, and exit. It's kind of like a rinse and repeat process, right? Number one. Number two, oftentimes I talk about short-term short-term trades because I live off my income. So this might not be you. This, you might have your 9 to 5 job, or you have your own business, or maybe you're retired and you want to do this as, let's say, some supplemental income, some cash flow, side gig, right? You might say. But me, because I live off of my income, I'm doing it every single week because I have commitments that I need to take care of financially on a week-to-week basis. So that's why I use weekly contracts. The stock you're choosing the strike price, and you're choosing the expiration date. Let's see. So the stock, what are you okay buying if you had to hold it for a long time? Are you okay with that? So we talked yesterday, like Warren Buffett says. Now Warren Buffett, he's like the cornerstone of investing. Everybody knows who Warren Buffett is, right? And he says like when he buys stock, he plans on holding it for like 50 years. Now that doesn't really, he does sell stuff, so he says some things and then he does some other things. But by and large, the point he's making is valid. What kind of stock are you going to buy? And are you comfortable holding that for a long time? And what I mean by that is this. Sometimes we can get, especially after you start trading, you can get kind of like wrapped up in like excitement. Oh my gosh, I'm telling you, you heard it here first. If this happens, you're going to be thinking at that time. Michelle talked about that on one of her sessions. You start making some money, you start telling your friends about it, they start talking about different stocks, and you start kind of kind of veering off the track a little bit, right? GameStop is a great example from that. Like how many people started trading GameStop when all that stuff was in the news, I don't know, a couple years ago. But you want to recognize, like, you don't want to trade some crappy stock like that you wouldn't be comfortable maybe a couple years from now because it's not that great. You don't want to just look at the dollars that you make on it. You want to have you want to have a comfort level of being like, I traded a put on this stock, and that's a great stock. It's a solid company. It's been around 100 years, 50 years, whatever. It's one of the biggest in the industry, that kind of thing. So keep that in mind for the stock. Now, what are some examples? I just put a handful of examples. I'm not recommending anything in particular, but especially when you're new, I always recommend a big company because listen, you want to like have as little amount of risk as possible. Like it's not about just making money. No, it's not about that. It's about like making money, being sustainable, and having as little risk as possible. So it's kind of like all those pieces. It's kind of like a dance, right? Like it's kind of like all these different things. I don't want to just sell a put on, oh my gosh, I'm going to sell a put on Meta because it's, a great stock, but it's $700 a share. Like I want to kind of like think about that when I'm new. Maybe I want to stick to for sure like some lower price stocks. I think Intel is great. Intel is like one of those stocks like you can never get hurt in, honestly. It's only 25 bucks a share. Long term, it's a great stock. If the price goes down, it's okay. It's going to go back up again at some point in the future, most likely. So those are just some examples, right? The second thing, what did we talk about? We talked about price, right? That's a strike price. How much do you want to pay for those shares? Now, what you want to keep in mind is this. When you're selling a put, let's say I'm selling an Apple put, and it's $120 right now per share, and I'm selling a $100 put, right? I want to recognize that, what that means is I'm committing to buy 100 shares at $100, right? Sometimes what happens, oftentimes, we let our emotions get in the way. The market starts like, let's say, dropping. Something happens, it starts dropping, then we start freaking out and we say, oh my gosh, I really don't want to buy that stock at $100. Well, you want to like kind of have that thought with yourself before you make the trade. Listen, you want to eliminate emotion as much as possible. Most of the people lose money in the market because they get emotional. They freak out. They get euphoric when prices are high. They get excited. Oh, I want to buy because everybody else is buying. They see what everybody else is doing. They kind of like want to jump on that train. And then when something goes down, they freak out and they sell their shares. Don't do that. I said this yesterday. I'm going to say it again. Some of these things I'm going to say multiple times because it's just important. And I want to like hammer it into your head. You only lose money if you sell your shares for less than what you paid. If you don't do that, like you don't lose money. I heard somebody else say this a long time ago. I forget who it was. I think, I think it might have been, maybe it was Ray Dalio or something. Some big investor said, maybe it was Warren Buffett. I don't know. But somebody said, the easiest way to make money is when you're small. So sometimes people will think, and sometimes people say this to me now, like, okay, like, you've been doing this for all this time, or you got a bigger account than I have, or whatever. Of course you make money, and of course it's going to be easier for you. No, that's not true. It's probably easier to make money when you have when you're starting off, when you have a, not starting off with like no experience, I don't mean it that way, but when you have a smaller account, that's probably the easiest way that you can make money. And the only time you're going to lose money is if you sell something for less than what you paid. So you're not going to do that. Now here's the rule, right? So when we talk about like how much are we paying for how much what strike price are we going to sell this put option for? How much do we want to buy that stock for? Here's what it means. The closer the price is, the strike price to where it's trading now, the more we're going to get paid, right? So let me go back to my example. Apple's $120 per share and I sell $100 put. It's kind of far away, so maybe I won't get that much money. But if I sold, let's say, $110 put, I would get paid more money. Why? Because it's closer to where it is, and it's more likely that it's going to stay in that range when it expires. So it's kind of like a logical thing, right? Some of these things, they might seem confusing at the beginning, but then when you think about it, that kind of makes sense. And then let's talk about the conversely the other way. The further away the price is to where it's trading now, the less you're going to get paid for the option. And let me give you an example. So Apple's $120 per share. Let's say I want to sell a $50 put. I don't want to pay $100. I don't want to pay 90. I want to pay 50 bucks. That's so far from $120. You're probably not going to get that much money if there's even like a buyer out there to make that trade, right? So that's something to keep in mind. What was the third part? So there was the stock, there was the strike price, and there's the expiration date. So what's the expiration date? How long do I want to commit for? Now remember, what I'm doing is I'm committing to buy the stock if and only if it drops below the certain price. And I wanna take a moment and a few moments and really make sure that you guys understand what that means, right? Let me take a sip of water. What that means is this. When I sell a put, what I'm doing is I'm committing to buy this stock, the stock that I pick, at the strike price, the price that I pick, if and only if the price drops below the strike price before the expiration date. So an example is this. Apple's $120. I sell a $100 put. It expires next Friday. The stock has to close below $100 for me to have to buy those shares. Now, as I said a few moments ago, it could chop around. It's really up to whatever that particular option buyer, if they assign it. So once it drops below, you have to be prepared. Oftentimes, I would say 90%, more than 90%. I think I don't even know how many trades I've put in my life, thousands, tens of thousands, hundreds of thousands, I don't know, a lot. And I would say probably I was assigned early, typically only when it went down a lot. So let's say in my example, I sell $100, Apple put. Let's say it went down to 70 and then it got assigned, right? I don't think I've ever been assigned at like 98, 99, 97 early. It just doesn't happen. I mean, not to say it can't happen, because it can. So you have to be prepared to buy those shares anytime before the expiration date, but usually it's on the expiration date. If it expires below the strike price, if the price closes below the strike price, you'll see your shares pop in your account on Monday. So that's something that you want to be aware of. When we talk about expiration date, how long do we want to commit for? So a few moments ago, I talked about that, when are expirations for options? They're every Friday. I mean, not all of them, the big stocks are. So what we're talking about are the big stocks, this Friday, next Friday, the following Friday. Sometimes in the past, and it depends on the market cycle, right? So right now, overall, the market is pretty high, like super high. Now, let's say, I don't know, I'll use 2008 as an example, because that's like a really good example, like the credit crisis. When everything crashes, that can be a really good time to commit for longer periods, if you have cash and if it fits into, what your intentions are. And the reason I say that is because the best time to sell puts is when the market is down, because everybody else is freaking out, the price is more expensive, we're going to get paid more. I think it might have been Warren Buffett, maybe, or maybe some other big traders. Lots of probably big traders did this. When everybody is freaking out, they're selling puts because they're capitalizing on that. Listen, it's kind of like the tide. Think of the tide in the ocean. The tide rises, all boats rise. What that means is the stock market's going up, everybody makes money. It's super, super easy to make money. But when the market goes down, that's when, if you're smart, if you got good strategies in place, if you have good discipline and you're not emotional, that's when you can make a lot more money. I don't want to say a fortune, but you can make a lot more. So the market goes up, it's super easy. Everybody kind of makes money. The market goes down, you can make more. So let's say we enter a super bear market. Bear market just means that prices are really, really low. That could be a good time to sell longer term options, because the longer you go out, the more money you're going to make. Actually, I think that's the next slide. The longer time you commit for, the higher your premium. And the reason is because you're committing for a longer period of time. So it's just like a logical thing. And the converse is true as well. The shorter time frame you commit for, the less that you're going to get paid. So if I'm selling an Apple $100 put that expires this Friday, I'm going to get paid a little bit less than if I was to sell an Apple $100 put that expires next Friday or the Friday after that. So those are things to keep in mind. Okay, so moving along, let's see. Let's go through a live demonstration. I mentioned I wanted to do this. Somebody asked yesterday about looking at some stuff live. So let's look at some stuff, right? I want to clean this stuff up. Let's look at Amazon. So let's see, hang on a second. The first thing I look at anytime I think about, and don't get confused. I don't want you to look at this screen and say, oh my gosh, what is all this crap on the screen? No, don't think like that. I do want to mention that depending on who you're trading with, your screen might look a little different. And also, even if you're trading at the same company, your screen might look a little different, because all these screens are customizable. You can add some stuff, you can take some stuff out, you can, make it look a different way. This is the way I have my screen look, and it works for me. I usually don't have all these stocks on the left here, but I was putting together these slides and I was just kind of looking at some different things that I thought might be interesting to talk about. So usually my stuff looks a little neater, but when I look at selling a put, at first what I do is I look at the chart, right? And I just kind of want to get a sense of where the stock has been. Now, this particular chart is a 1-year chart. So usually I'll look at, this is Amazon. I'm not trading Amazon. I have traded Amazon, but not for a while. But I thought it would be an interesting one to look at. This is a 1-year chart. So me personally, I use bars. So I think, I don't know if we went through that yesterday, or if maybe that's upcoming, I can't recall. But basically, you can look at bars on your chart, or you can look at candlesticks. So bars are kind of I don't know, that's the way I learned a long time ago, old school. Most people look at candles. I'm just the opposite. I look at bars. But you can look at either. It gives you the same information. But basically, a bar, each one of these lines it represents one day in the market. You'll see, I think you can, it's kind of small. And I'm always wearing glasses, but you can see you see the notch on the left and the notch on the right of each of these ticks. What that represents is the notch on the left is where it opened at, the notch on the right is where it closed at. The top part of the bar is just the high for the day, and the bottom part of the bar is just the low for the day. It might look confusing, but it's one of those things, like we said yesterday. It's I just moved to New York and I go to Whole Foods and I don't know where anything's at, because I'm trying to get used to things. This is the same thing. Once you get used to it, it's easy. But as an example, I'm going to look at the chart for 1 year. I can change the date, by the way, if I go here. So typically, I'm only ever looking at 1 year, 1 day, and 1 day, 1 minute. So that's kind of it. So this is like a 1 day, 1 minute. You'll see the gray shaded here. That was yesterday. And then this black is like today. Actually, the gray shaded is the overnight. And you can customize this. Some people don't look at the overnight. I look at the overnight. So this is kind of like when the US was sleeping, other countries were trading Amazon, and where did it go? Oftentimes, when we look at an overnight data, it doesn't trade as much. So you'll see kind of like choppy, see kind of like choppy lines because it's not as active. The US is much more active in US stocks. So that's what I kind of look at. One minute, and 1 year, 1 day. And then I just kind of get a sense of that. And then if we look at, let's look at selling a put. So let's look at the trade section, right? So this is kind of like if I close this is our what's called our option chain, right? So it's always called the same thing. And here's all of our dates, right? So let's say I want to look at this Friday. Today's the 26th of August. And I want to look at the 29th. Amazon is right now, its last trade right here, or over here, we can see it as well, $238.11. And let's say I want to sell a $200, put as an example for this Friday. What we're going to look at, we're going to talk another time about bid and ask, but right now we're going to look at just the last price. So that's kind of like, where did it last trade? That we can also say like, what's the current price? It's the same thing. 0.03. What does that mean? You might remember from yesterday, hopefully, that we're always multiplying times 100 because there's 100 shares in a contract. So 0.03 is $3, right? And that means that it's not much money. So that means we would not make that trade. I'm just kind of like walking through some different scenarios on what you look at and how you look at things. That means that we would get paid $3 for committing to buy 100 shares of Amazon at $200 per share. Now, why is the price so cheap? The price is cheap because there's not much likelihood Amazon's going to go to 200 between now and Friday. And the reason I know that is because I look at this is like a cheat sheet thing. It's kind of like, I use Delta all the time. There's some other traders, friends of mine, actually one really good friend of mine who never used to use Delta. And we used to like kind of bicker a little bit about what Delta means. Delta has this kind of like technical explanation that it's like the rate of change, blah, 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 which it is. However, it's also sort of like the cheat sheet way of how likely is something going to go from where it is now to the strike price between now and the expiration date. It's a statistical likelihood. So where does that number come from? It comes from, it's like mathematics. It's coming from the broker dealer that I use right now. So this is Schwab as an example, but it's also provided by, Interactive Brokers, E-Trade, whoever it is that you're trading with. So they're saying that there is a 1%. See, if I go down, Delta's here, puts are here, by the way. Remember, calls are on the left. So we're just talking about puts right now. I'm going to go down the strike price right here, down the line, 200. I'm going to scooch over, and it's 0.03 for the price. It's who cares about the negative? Ignore the negative, but the number itself is 0.01. That means it has a 1% likelihood that Amazon is going to go from 228 to 200. Today's Tuesday before Friday, right? So it's not very likely. And because it's not very likely, the price is not that low, not that high, right? So that's what I'm talking about. Now let's look at something else. Let's look at the price is 227. Let's look at a 225 put as an example. So the 225 put is going to be more expensive. Why? Because it's more likely that it's going to land at that price before the expiration date. So 225, we're going to go down the line, the strike line, 225 puts are over here to your right. And we're going to scooch over. Where did that last trade? 99.99, which means $99, right? And you see how this flips all the time. Now it's 101. That's because this is live data. So anytime you trade, you're going to automatically make sure what you're looking at is live data. I was like teaching somebody not long ago, and I don't remember exactly what happened, but I didn't even realize, they didn't realize, I don't know, they weren't looking at live data. It's free. First of all, you don't have to pay for it. And there's no reason in the world that you would not opt into live data. There might be like a form you have to sign electronically with your brokerage, but make sure you have that and you're not looking at delayed stuff. Now it's 103. See how it's flipping all the time. What's the delta on this? Well, this was 0.29, right? So there's a little bit more likelihood that it's going to drop down to 225. So you see kind of like what that correlation is. Right now the price is 227 and change, almost 228. The 225 put is more expensive than obviously a $200 put because it's closer to where it's trading. I'm going to use SPY as an example because SPY, let's see, August 29th, SPY is something that for some reason, I always encounter people that trade SPY. And I want to show you, SPY is an ETF. It's the S&P 500 exchange traded funds, right? And people will think that it's not as risky because it's a whole bunch of stuff in there, right? I think they're just brainwashed from like Wall Street, like telling them that diversification is good and, buy this thing. Like we talked about yesterday, I don't know how much, let's see how SPY, you guys can see my screen, right? SPY AUM. I'm going to see how AUM is assets under management. I'm going to see how much assets under management SPY has. 650, wait, I don't even know what that number is. That's a bigger number than I can comprehend. 651, but it's million. So I think does that mean, I don't know what that means. Huh. Wait, what is 625 million? That number is too big. I guess, I don't know. I don't want to spend a lot of time. My point that I was making on this, oh gosh, where did I go? The point that I was trying to make was this. People talk about SPY and they're brainwashed because Wall Street wants you to trade SPY because they are making oodles of money. The number is so big that what they're making, I can't even comprehend it. But let's walk through an example. SPY right now is $643 per share. So let's break this down easily. First of all, what does that mean? That means that if we sell a put on SPY, let's say a 600 and let's see. And you could change, I like to look at all the strikes, but let's just look at some of them. And that way we have less stuff on the page, right? Right now, SPY is $643 per share. Let's say I want to sell a $640 put, right? 640. Now, what do? We go down the middle, strike price. We go off to the right because puts are on the right. And that last traded at 2.18. That's $218. Now, before you say, Michelle, $218, that's a lot of money. And that's more than what we're talking about for Amazon. Yes, correct. However, let's look at the whole picture here, right? It last traded at 643. If I sell a 640 put, I am committing to buy 100 shares at $640 per share. Let me pull up a calculator. Let's see. Applications, calculator. Okay, I could do that in my head, but I'm going to show you how easy it is in case you can't do it in your head, right? 640 times 100. That is $64,000. Okay, now I am committing to buy 100 shares at $640 per share. That's $64,000, and I'm making 188 bucks. Now let's bring it one step further. Let's look at the delta on this. What is the statistical likelihood that SPY is going to drop from 643 to 640 between now and Friday? It's 34%. Now that's not that low. I mean, it's not super high, but it's also not that low. Why would I want to make that trade? Let's also, I'm gonna give you guys some more info. This is how I check. Now you can check a few different ways, but the easy way to check, since I'm looking at this page, is how much, if I don't use if I use margin, how much money do I have to put up? Now, if I don't use margin, I have to have 64K or 60K rather. or what am I looking at? 64K, sorry. 64,000 in my bank account, in my brokerage account to make this trade. But if I use margin, I'm going to click on the bid, and I don't want to bore you with getting the weeds too much, but I want to see like how much is the margin on this. Okay, so I have to have $9,600. This is the margin requirement, 9,600 to make that trade. Let me back up, and I want to say this a couple times because I want to make sure that you guys understand, right? SPY is 643 a share. I'm going to sell a 640 put, right? I'm going to get paid $184, right? If I don't use margin, I need to have $64,000 in my account to make that trade. Why 64,000? Because 640 times 100 is 64,000. I get paid $187. There's a 34% statistical likelihood that I might have to buy those shares. If I'm using a margin account, which I use margin personally, if I'm using a margin account, I have to have 9,600 bucks in my account to make that trade. Now I use calculators that I'm going to release to the public soon, but I'm going to show you how easy it is to give you like a rough idea to calculate that. Is this a good trade or is this a shitty trade? I already know the answer, but I'm gonna illustrate it to you, right? I'm gonna make $187, right? We see it, right? 1.87 in the last column here. I'm gonna make $187 and oops. And I'm committing right here $9,600. That's my margin. 96.23 to be precise. 9623. Okay, if I make that trade and it expires worthless, I'm making 1.9%. And that's not like terrible based on the margin amount that you need. Really 64,000. Let's break this down a little further. If 100% of the money is 64,000, but my brokerage account broker is telling me I only need less than 10,000, that means that he's giving me a lot of margin, right? Like he's saying, man, you can make this trade. You don't really have enough money. Let's say if your account's smaller, but you can make this trade anyway. They set broke. This is like the scamminess. I'm gonna include some of the sliminess in Wall Street. First of all, different broker dealers have different requirements for stocks, right? Number one. And number two, a different broker dealer will have a different requirement for SPY versus MicroStrategy versus Apple versus whatever. And really the idea behind that is they're kind of evaluating what's the likelihood that, you're going to have to buy those shares, right? The reason they give you some margin is because right now SPY is here. And if you're selling a put here, it's probably not going to happen because there's only a 34% likelihood. But if it does, that's kind of like included in how they determine how much money you need. In my opinion, and this isn't like written down somewhere, but the reason why you get a lot of margin ability for SPY, like, if I needed all the cash at 64 grand, but the bank will float me the money and I only have to put up less than 10 grand. It's because they want you to trade SPY. They want, like, it's $1 trillion ETF. And remember, they make shit tons of money off of that. Anyway, going back to my example, you're making, let's say, almost 2%. So 2% per is not that bad. Let's say you hold it for a week times 52, right? I know it's not a full week because it's like 4 days, but I'm just going to give you an idea, an approximation, right? So you're making like 101% on your money if you calculate it using your margin requirement. For certain things, I encourage you not to calculate it using your margin requirement because it can be like a fictitious thing. If the margin starts to drop, so here's what happened, and somebody asked a question earlier. This is a really good session. This is for those of you that have a little bit of options kind of like experience. This is going to be amazing content. Where was my train of thought? So for your margin is less than 10,000. However, really like there's a little bit more risk to that because it's pretty close. I mean, $643 right now is where it's at. And if I sell a 640 put, let's calculate that based on the money that I need to put up if it came down. Because here's what happens. If I put that trade in and my margin is $9,000 right now, and SPY drops, and let's say something big happens. I don't know, there's some war with, you know, China or whatever. I don't know. Something big happens and SPY drops to 600. My margin is going to go from 9,000 to 39,000 like this. And somebody asked a question a moment ago, like, is the broker dealer going to call you? No, they're going to just break your trade and they're just going to like make you lose money. So that's why some of these chips are stacked against you. You don't want to make these mistakes. Let's calculate if I had to use all the money, right? So let's I think it was $187, 187 divided by, let's say if I had to put up all the money, 64,000, right? Oops, 64,000. Let's see what that rate of return is. That's 0.002 times 52 weeks a year to get our annualized rate of return. Now we're only making 15%. So now we were making 100%. Now we're making 15%. You know, it's a big difference. Don't trade SPY. Let's look at something else. Let's look at Intel because I talk about Intel with young, new traders. Let's look at the chart. This is like a 1-year chart. This, by the way, I'm going to give you some tidbits. You see, when we look at a chart, somebody asked like about technical analysis and what I use. I don't use any indicators ever. Sometimes in the past, I've used some moving averages. I haven't lately. I look at certain things like gaps. Like, see, look at this day right here where it dropped, and then the next morning it opened like way lower, right? That, when we see that in a chart, it's called a gap, GAP. That means that it closed here, right? And then it opened the next day much lower. How did that happen? That happens because when the US goes to sleep, other countries are trading. And so when other countries are trading, it drops significantly. Something must have happened in the news, I don't know, whatever, to cause that. Now, the reason why gaps can be helpful, and this might be a little bit more information than what you guys are here for, because I know that some of you are beginners and you want to learn the basics, but this is kind of good to have as well, just some extra information. Gaps will typically fill. What that means is if I'm looking at these dates here, like this was, I can see the date up here, like right here is your date. I think you guys see my mouse hovering. So this is like August, right? Early August, 8.5, 8.6. So really, like if there's a gap in the chart and then the price is trading much lower, if I want to trade Intel at that time, it's a pretty good trade because it's probably going to go up. Gaps will fill, and you see that's exactly what happened. Gap, like the price started going up, 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 and then now it's kind of like went even higher. But let's go back to our example. Intel is $24.28 per share, right? And let's say we want to sell a $24 put, right? So I'm going to look at August 29th. I'm going to look at a $24 put. And where did it trade right now? 40. Or let's even go a little bit cheaper. Let's go do a 23.50 put. Now, by the way, you guys might notice as we talk about this, when we look at the strikes in the middle, they're not always the same thing. In other words, when I look at an Intel chart, it's $21, $21.50, $22. But when I look at SPY, that we were looking at before, it was, 645, 644, 643. So it depends on what the particular stock is, the increments that the strike prices are. So that's something to keep in mind. Yep. So let's go back to Intel. It's 24.25 per share. Let's look at a 23.50 put. Right? So right now it's trading at $22. 0.22, which means that we're paid, we multiply that times 100. We're paid $22 to make that trade. What's the likelihood that it's going to reach 23.50 between now and the expiration date? 28%. So not that likely, but not super, super low. Let's see if that's a good trade. Let's just, I don't know. I wasn't planning on talking about calculators and calculating that stuff today. But let's just talk about it to kind of see what that looks like, right? So 23.50 is 22 bucks, right? $22. Let's see how much money we need to make that trade first. So if we have a Schwab account, you just click on the bid here. I right click and then I click analyze trade. And it's like an easy, quick way. I already had some stuff here, so that's what I'm deleting. Sometimes when you look at things, it'll save it until you delete that window. This is actually a really good teaching moment. 2350 put that expires Friday, August 29th. Right now, and this number is going to change. Remember, this is live data, so it's going to go up and down. Right now, it's 23 bucks. How much margin do I need? $450. So this is an example of you don't need a lot of money to trade. You just don't. I need to have $450 in my account to make this trade, right? I get paid 20, now it's $24. Let's see what that rate of return would be. $24 divided by 450 is 5%, 0.053. That's 5% for the week. Now, if I annualize this out times 52, and I know I'm just kind of using approximations here because today's Tuesday, it's not a full week. I'm just giving you an idea. I would encourage you, if you want like tools that will help you do that, join my inner circle. It's free, and when that tool is available to the public, I'll be sure to let you know. It's off the hook. It's amazing because I used to input into a spreadsheet like manually. Okay, here's my premium, here's the margin, blah blah blah. What's my rate of return? But the tools that I'm making as a feed, like API feed, that grabs that data and calculates it and fills it all automatically for you. Okay, 55% per week. Oops, sorry about that. Times 52, 277%. Yesterday, I think it was yesterday, I did a video. People think like if you tell people that you're making over 100% each and every year, people think you're full of shit. Like it's not possible. It is possible. I mean, you see what I'm talking about, right? So let's use not margin, but let's use like, okay, let's assume you don't want to use margin and you want to have all the cash in your account. If I sell a 2350 put, how much cash do I need if I'm not using margin? This is how easy it is to do yourself, guys. Do you see yourself doing this on a regular basis? Send me some love in the in the presentation. Make sure you're still paying attention and tell me if you see yourself doing this. 2350. Come on. Oh, there's some love. I see it. Thank you. 2350 times 100, right? Is $2,350. And let's go back to my price. Thank you for some love. I appreciate that. $23 for the week divided by 2350. If we're not using margin, what's our rate of return? It's a little bit less than 1%, right? Times 52. Here's what that means, guys. I'm going to break it down in plain English for you. Even if you're not using margin and you're putting up all the money to make this trade, as an example, Intel, I don't have the screen, the slide in front of me, but Intel is, I think they've been around like 60 years. I think the government just invested 10% into Intel for some, I don't even know a lot about the details, some public thing. They want to like encourage US chip makers or something like that. Long term, it's a good solid company. Might the price go down? Okay, maybe. I mean, the prices always go like this, but long term, is it likely to go bankrupt or go out of business? Probably not. And even if you don't use margin, if you have all the money, if you make a trade like this or similar to this on a weekly basis, you're making 50% on your money. Like anybody can do this. So I hope you can start seeing yourself be able to do this. Where's the risk? You may have to buy. So when we talk about, let me back up for a moment. When we talk about selling a put, where is the risk? We might have to buy that stock cheaper. Let me go back to my Apple example I was using before. Apple's 120 per share. Let's say we sell $100 put, and let's say something happens and Apple is now trading at 80 bucks, right? And Friday comes, and then we say, oh my gosh, I have $100 put. Well, guess what? You're committing to buy Apple at $100, and Apple's at 80 bucks. So you might have to buy it cheaper than where it's trading now, right? I mean, that's just part of the game. It's not like a game that's like no risk. It's like low risk, evaluate the risk. Is that something that you have to do? There is a way to combat this. I'm going to talk about in a moment, but that's something to keep in mind. Now, also, I do want you to understand, in my scenario, Apple's $100. It drops to 80. Apple's 120. I sell $100 put, it drops to $80. if and when I buy those shares, that will only be a paper loss unless I sell those shares. Now, I want you guys to really understand and listen to what I'm telling you. What that means is even if the price goes super low and I have to buy it at that higher price, it's only a paper loss until something happens. What does that mean? That means the price is going to go like this. Just wait till it goes back up. Wait till like if you're not living on it. So for me, this is why it's easier trading for small people, I think. For me, as an example, I'm living on my stuff, right? So like right now, for example, I have a bunch of Coinbase, and Coinbase dropped a lot. And I can't, it's hard for me to sell calls against it right now. I'm not talking about calls yet until tomorrow. But what I mean by that is it's a little bit harder for me because I'm like depending on generating more income. If you're starting off and this is like a side gig for you and you're thinking like, oh my gosh, how cool would that be if I can make a couple $100 a week extra? Like how would that change my lifestyle if I can make an extra $1,000 a month? If that's you, if you're the person that fits that description, then who cares what the paper loss is? Because you're not depending on that money. Just wait until it goes back up. Also, here's what you can do. So worst case scenario, it goes super low. You buy it at a higher price. I just talked about this. Also, what you can do is you can average down your price. Now, let me spend a minute and talk about this, right? It is like one of the biggest, what's another word for farce? It's like one of the biggest misconceptions that you should use stop losses, right? And I've gone through different cycles and sometimes I use stop losses, but by and large, I don't. Here's what a stop loss is, as an example. Let's say I buy Apple at 100 and then I say, okay, and you could do this if this works for you, great. For me, it really doesn't work for me. What you do is you say to yourself, okay, I'm buying Apple at 100, but I don't want to lose all my money, so I want to have like a safety net. I want to put a safety net on that trade, and I want to only lose, let's say, I don't know, $30 per trade. I can put in an order to sell my shares if it goes down to 70. That way, I don't ride it all the way down. I could, get out at 70. Here's the problem with that strategy. So many times, countless times, the price comes down and then it goes back up again. Because here's what happens. If you're trading a good stock, Apple, I don't know, Google, Amazon, like all these big companies, if you look at extended periods of time, what do? They go like this, but overall they go up. So why would you want to take, okay, the price came down. I have a paper loss, which doesn't mean shit, right? You can wipe your ass with a fucking paper loss, right? It doesn't mean anything. Sorry. Oh, my language is going a little bit. It means nothing, right? Let me get back on track. It means nothing, but instead you're going to take that loss. When you take a loss and you sell your shares, now you recognize that loss. That actually is a loss that like comes out of your pocket. So there's a very big, you have to understand if you're trading, you really, really have to understand the distinction between a paper loss and a real loss, a paper gain and a real gain. So instead of recognizing that loss, you can do this. You could buy more shares and you average down your costs. Warren Buffett says this. I don't know why I keep talking about Warren Buffett because I don't even really follow him that much. But I know that a lot of people know him and he does say amazing things and he is a super smart and successful guy. He says if you like the stock at $100, it's still a great stock at 90. It's a great stock at 80. In fact, it becomes an even more attractive purchase as the price comes down. So when you average your stock down, what that means is you're just buying more shares cheaper. So this is an example. Let's say you have 100 shares of ABC, you paid $30, right? And this is your cost basis. Oh, I was missing a parentheses there. Okay. The stock goes down to $20, right? You paid 30, now it's 20. Don't freak out, right? You traded a good stock, you didn't trade some crappy stock. What you can do is you can buy another 100 shares at $20. Now your basis is 25. I'm going to show you how easy some of this stuff is to compute. You don't have to be a math whiz. You don't need, like, I use like a lot of spreadsheets and calculator tools, but you could just use this, right? So I paid $30. for shares, and then I bought some more shares at 20 bucks. And then I divided by 2. That means my new basis is $25 per share. Now you have 200 shares at an average $25 each. So it's like a way to, it's a very good trading strategy to use to average down your cost, right? I want to get through some of this. Let's see. The only way to lose money, like I said, is if you sell something for less than what you paid. Don't do that. At expiration, this is important. When your contract expires, one of two things is going to happen. The stock price will either be higher than your strike price, or it will be lower than your strike price, right? So what that means is, let's say I sell a $100 Apple put. When it expires on Friday, Apple's going to be more or less than 100 bucks, right? That's what that means. If the stock is higher than your strike price, that means your contract is going to expire worthless. There's no more risk on the table. It's called out of the money. That means that you already collected that money, right? And that's it. Next week, you look for another trade. If the stock is lower than your strike price, that means you're automatically going to be assigned the shares. Now, we talked about that a moment ago. If I sell a put on Apple, $100 put, and the price is 90 bucks, those stocks are going to show up in my account on Monday with $100 basis, right? That's called being in the money. The stock is in the money. Now, you could also, instead of waiting until expiration, I want to make sure that you guys understand that you can close your position early. I touched on it earlier in the presentation that you have a lot of flexibility. Like when you make a trade, you don't necessarily have to stay in that trade. What do I mean by that? That means that, like, if I'm selling a $100 put, let's say, I don't know, something happens in a couple days and I just change my mind. I don't know. I'm Aquarius, so I change my mind a lot. And let's say you want to change your mind and you don't want to like be on the hook to buy 100 shares at 100 bucks. You can close your position. You could, what that means is you buy it back. Most people get confused by that. I encourage you to just use like easy terms, liquidate. You can liquidate your position. The reason why you're buying it back is because when you sell a put, you're actually short a contract. I don't want to get too confusing and I don't want to lose anybody. So I just want to be easy. You liquidate your position at the market. That might be more or less than what you originally got paid for it. Here's what that means as an example. I didn't have any puts in my account. So I sold this NVIDIA put before this class started, like, I don't know, a couple hours ago, because I wanted to show you how it looks. I just did a screenshot from my account. And I screenshot each piece because I didn't want to, honestly, like, I don't put all my business everywhere. Like, this is a public thing, right? I don't even know who's listening. So I don't want to show you exactly everything that I have, but I just gave you like examples and to illustrate sort of what these things mean. So this is the trade that I made this morning. I sold an NVIDIA put. Let's look at a NVIDIA, right? For example. So NVIDIA right now, let's look at the chart first. So we always look at the chart, right? So here's where NVIDIA is. It's kind of like chopping around. And the price right now is 181.43, right? What did I do? I don't even remember. I sold a 165 put. Let's look at it. And I got paid. The cost per share is how much I got paid. So -1 because I sold the put. The cost per share, I got paid $102. 1.02 means $102. Let's look at that. Let's see. So NVIDIA is 181 and change. And remember, I'm going to go down the middle of the aisle. Strikes. Off to the right is the puts. And what did I sell? I think it was a 165. Yeah, 165 put. It's right here. So here's what that means. So right now it's trading at 1.07, right? There's a 13% likelihood that it's gonna go down to 165 before Friday. So it might happen. if I wanted to buy back that position, because I just sold it just to give you an illustration. Oops, sorry. And I sold it for 102. I could buy it back right now, right? And the way I do that is I would just click on here. I would buy 165 put. Right now it's trading at $106, $107. What does that mean? That means I got paid 102. I bought it back for 107. I would lose $5. That's what that would mean. But here's the thing, guys. Like options are super flexible. It gives you the ability to change your mind and get out of positions. You don't have to hold it to the expiration date. I also had some examples here, like MicroStrategy. I have MicroStrategy, 200 shares at the moment. My average price is 433. Right now, MicroStrategy is a lot lower, so I bought those at much higher. 415 call that I sold, I think, a couple days ago. Or maybe it was yesterday. No, Friday. I don't remember. Anyway, I got paid like $100 for it, $99. Not that much money because it's super far away from where it's trading, right? $415, and it's trading, lower. If let's see, this was this morning at $10, but let's see where that contract's trading right now. A 415 call. I know we're not talking about calls yet, but it illustrates the same idea. Let's see. So 415 call right now, last traded at $11. So here's what that means. That means that I sold the contract for $100. Right now it's worth $11. If I wanted to, I could buy it back and pay $11. How much money would I make? Let's take a look. I sold it for 99. I would buy it back for 11. So I still made $88, and then I close that position. I take that risk off the table. Maybe I wait until MicroStrategy pops up, and then I sell another call or something like that. So it's very, very flexible. If you get assigned the shares, right? So that's the other thing. So like if you wait until expiration and you get assigned the shares, you're going to buy those shares at the strike price. But I want you to be aware that your cost basis gets adjusted. Now, this might be a little confusing, and honestly, if you tune out a little bit, it's okay. This is like maybe something that it's important to know, but not uber important as far as, it doesn't help you, put the trade in or understand it. But I do want to let you know that if you sell a put and you have to buy those shares, your basis gets adjusted. Now let's talk about that. And I hope I don't lose anybody because of some math here. Let's say I sell an ABC put at $100. I take in $100, and then ABC stock closes at $47, and I have to buy the shares, right? They show up in my account on Monday, typically, with a price of 50, because that was the strike price, right? However, it depends on your brokerage firm. I use Schwab, and usually it happens on Tuesday with Schwab. On Tuesday, the new basis, which is the actual cost that you own the shares for, will become 49. And the reason for that is they adjust it by the premium that you got paid. So if I got paid $100 on the trade, that's like $1 per share. It's 100 shares. So my basis goes from 50 to 49. So it's a little bit more advanced, but I just wanted to kind of clarify that for anybody who might have been curious about that. Somebody was talking also about the wheel. Let me talk about the wheel for a moment. I find that term like cringy. I don't know why, but people talk about wheeling, right? What that means basically is that you sell a put and you're collecting premium, right? What is selling a put? You're committing to buy those shares at a particular price if it drops below that price before the strike price. Now, if it doesn't drop, you don't buy it. But let's say it does drop. The shares drop. I buy the shares. Now I have 100 shares of that particular stock. What do I do on Monday? Now, Monday, I sell a call against it. It's like, that's a really good strategy. So you're selling a put, you're keeping your money in cash initially, you're selling a put, you're committing to buy the shares if it goes down. If it doesn't go down, you don't buy them. If it does go down, you do buy them. What happens if you buy the shares? You bought stock that you like anyway at a price on sale. Like what's the problem with that? And then you sell a call against it on Monday. So that is a really good strategy. Let's see. I think just to wrap up kind of like what we talked about, it's kind of like hits all home and like I personally just try to keep things simple, just do the same ones over and over and over again. But as you go, if you find something that works for you, like if you look into something, okay, well, I want to look into trading during earnings, right before earnings, or I want to look into what's overbought, what's oversold, and you get in a rhythm. That's fantastic. Keep your rhythm. Like, listen, my way is not the same way for everybody. To wrap up, kind of like like just solidify kind of what we were talking about. What is a put? Because really, again, like I said earlier when we first started and yesterday, there's only two strategies. There's lots of different ways that you can trade. Um, Spreads, a lot of people trade, credit spreads. But there's two main strategies that you need to know to be successful. Only two. You don't need any more. Selling a put and selling a covered call. Selling a put, what does that mean? That means that we are agreeing to buy 100 shares of this particular stock at this particular price if it drops below that price before the expiration date. For that agreement, we're paid a premium. We get paid the premium right away when we enter the trade, and we keep that premium no matter what happens, right? How does that sound? Does that make sense? At expiration, well, we did talk about this already. If the stock is higher than your strike price, you do not buy the shares, right? If the stock is lower than your strike price, you do buy the shares. They will show up automatically in your account, and either way, you keep the premium. So that's something that you want to keep in mind. Now, I know that sometimes, I know some of this might sound confusing, right? Um, puts and calls and delta and strike price and all this like different like terminology, that you're not familiar with. But the simple fact of the matter is this: all you need to do is practice. So the best way to practice initially, um, especially like maybe this is something good that you could do today. And as we go through the sessions, it might like click a little bit faster for you. Just open a trading account, open an account, and then you can open a paper trading account, right? So most big broker dealer firms have what's called paper trading, and it's like practice. So it's just it's not real money. It depends on, I don't know, it might like be $100,000 or $250,000 or whatever. But it's practice that you can kind of like, then you can kind of go like this. You can click around. Okay, well, I want to buy, let's say 100 shares of Meta, and let's see, I'm going to buy this, and I'm going to look and see how that works, and blah blah blah. And then you can, put a trade in today, and then you can follow those trades for a period of time, and you can kind of get a sense of how that works. Or you can open a regular account and you can just start small. I would say be very, very careful when you start. First of all, I want to make this clear. I know I said it before, but I can't say it enough sometimes because I don't want anybody to misunderstand. I'm not recommending any particular trade. I'm just kind of sharing what works for me. I truly 100% believe that Wall Street, like I'll just say Wall Street because I just termed them and I live in New York City. I just term them all Wall Street. Um, uh, you know, puts people under a spell and makes people think that like, you need to depend on somebody to help you with investing. And the fact is this: nobody's going to ever treat your money better than you will. I guarantee you. These are strategies that I have not been using, for a short time. I've been using them for a long, long time. And I think they're strategies that work whether the market's going up, whether the market's going down. Now, that said, sometimes puts might be more advantageous in down markets, and calls, selling covered calls might be more advantageous in up markets. But as a general rule, like both of them are always applicable in all market cycles, in my view. But it's important to use the community for help. So like I truly believe that it's important to sync with other like-minded people.